Welcome to Talk Tickers, where we break down the earnings calls that move the markets. Today, we're digging into Titan Machinery's second quarter fiscal 2026 report.
So check this out. On the surface, Titan Machinery delivered a solid beat on both the top and bottom lines, and yet the stock sold off sharply. So what is really going on here? Let's dive into this market paradox.
To figure out that drop, we have to get past the headlines. We need to unpack the numbers, both the good news and, the bad news.
Okay, first, the good news. Revenue came in really strong, beating the Wall Street consensus by over $42 million.
And on the bottom line, while the company did report a loss, it was way smaller than anyone feared. They beat analyst expectations by a pretty significant 22 cents per share.
So with two clear beats, why did the stock tank? Well, investors ignored those headlines, and they zeroed in on the massive pressure that was hiding deep inside the company's core business.
And this chart illustrates the problem perfectly. A total collapse in domestic ag equipment margins. I mean, look at that. They've fallen to just 3.1% in the first half. That's a tiny fraction of their historical average. It signals that the company is making some deep and probably painful pricing concessions just to move product.
And when you look across the business segments, you can really see that weakness in the core U.S. operations. Now, this was kind of masked by a huge stimulus-fueled surge over in Europe, a spike that investors probably correctly saw as temporary.
But here's the twist. This margin compression, it wasn't an accident. It was actually a deliberate, and you could argue, a totally necessary strategy for management.
See, management is executing a classic downturn playbook. They're sacrificing short-term profitability to clean up their balance sheet and get ready for the next cycle.
The core of this whole strategy is something called inventory optimization. Titan is using aggressive pricing as a tool to clear all that excess equipment off its books and get cash flowing again.
And you know what? It's working. By selling off all that inventory, they caused their floor plan interest expense, that's the cost of financing all that inventory, to just crater, from $13 million down to just $1.5 million, all while keeping their other operating costs totally under control.
Now, to really understand Titan's strategy, we got to zoom out a bit, because this isn't just a Titan problem, we're talking about an industry-wide trough.
Titan is not fighting this battle alone. The entire agricultural equipment sector is in a cyclical downturn, a fact that's been confirmed by the industry giants, like Deere and CNH.
So the bottom line is this. Low commodity prices, high interest rates, and a glut of used equipment are creating some powerful headwinds, and they're affecting every single player in this space.
So, with all that in mind, let's put all the clues together and deliver our verdict on Titan Machinery. And there it is. The mystery is solved. The stock didn't fall because of the quarterly results themselves. It fell because management made it crystal clear that the path through the rest of this fiscal year is going to be painful and it's going to be unprofitable. Now, management did lay out a clear path to recovery, but their message to investors was pretty blunt. Do not expect a real turnaround on margins until fiscal 2027. Our rating, therefore, is market perform. Look, the company is absolutely making the right strategic moves for the long term, but those industry headwinds, they're just too strong to justify a more bullish stance right now.
So, with that verdict in mind, what's a potential trade here? Let's talk about it.
Let's say you believe management can successfully navigate through this tough period. How could you position yourself for that eventual turnaround they're aiming for in 2027?
One potential strategy is what you might call the trough turn trade. This involves using long-dated call options, also known as LEAPs, that expire out in January 2027. The idea here is to get exposure to that potential fiscal 2027 recovery while limiting your upfront risk during this bumpy period. But be warned, if this downturn lasts longer than expected, those options could expire completely worthless. This is not financial advice.